In this video, I'm going to go over my experience with trying to get a mortgage loan forbearance. Coming right up. Hey guys, welcome to the channel. If this is your first time here, my name is Sean. I'm a real estate investor based here in the Bay Area. And on this channel, we go over tips and tricks to help you learn more about the business and to help you achieve your financial goals. In this video, I'm going to go over my experience of trying to get a mortgage forbearance for my property here in Milpitas. So before we get started, what is mortgage forbearance? Well, forbearance basically means that you can delay making payments on your mortgage without having it directly affect your credit score. Normally, if you don't pay your mortgage, then the mortgage company will report that you were late on payments, and that can negatively affect your credit score. So obviously, if you have a loan, you need to make the payments on time, or you contact them and you say, hey, I'm under some financial hardship. Can I delay making payments during this time? And that agreed delay is called a forbearance. And because of this whole COVID-19 situation, the FHFA, the Financial Housing Finance Agency, have directed lenders who service Fannie Mae and Freddie Mac loans to offer mortgage forbearance programs to their clients. So basically, if you have a loan that was conforming and was sold to the Fannie Mae or Freddie Mac programs, then you are mandatorily allowed to be in this forbearance program. But what does that all mean? And is it worth going for it? So I actually called up my lender yesterday to ask more information about it, because it would be amazing if I can just say, I don't want to pay my loan for the next 3 or 6 months. Can I take that loan and just push it out 6 months? So instead of paying it in, let's say, January of 2050, I end up paying it at the end of June of 2050. So you extend your loan by 6 months by not paying it right now. As of now, only people who have Freddie Mac and Fannie Mae mortgages are allowed to have this mandatory forbearance. But if your loan amount was greater than, let's say, $750,000, typically those are called jumbo loans, and the actual banks hold on to those. So if you have a jumbo loan, then the bank does not have to give you this forbearance. Like, they can say, sorry, we own this portfolio, we're not regulated by the FHFA, sorry, you're out of luck. Since I've been told that you might as well give it a shot, I did just that. I called my lender yesterday, and after waiting on the phone for 30 minutes, finally I was able to talk to somebody. And of course, the reason why it takes so long is because everybody's trying to call the banks right now to get on this forbearance program. Because why not? It's great to not have to pay your mortgage for an extra 3 or 6 months. Now, after calling them, you realize that it's not as simple as it seems. First of all, you have to fill out a lot of documentation. Documents can be between 6 to 20 pages long, depends on what kind of financial statements you have. And then ultimately, it's not even that great. After your forbearance plan is over, you have to pay it all back day one. So for example, if you say, I need a 6 months forbearance program, then yeah, you don't need to pay your mortgage for 6 months, but at the end of the 6 month period, you have to pay it all back at once, which is terrible. Like, who has that kind of money? Not to mention, if you have an escrow account that's part of your mortgage, then you still have to make those payments for your escrow account. Otherwise, your escrow account may be underfunded. Now, if you don't have a mortgage, you might be wondering what an escrow account is, but an escrow account is basically a place where your bank will ask you for more money every single month. So if your mortgage is only, let's say, $1,400, they might charge you $1,800 because they know that you're gonna need that extra $400 a month to pay for your property taxes and your insurance, or something like that. The escrow account is for those extra funds that go towards those other bills. So you still have to pay that, but at least you have to pay the principal and interest portion of your loan during your forbearance period. But then having to pay all that back in 6 months, that's not effective. Like, I might as well just keep paying and not have to go through all the trouble. Another thing too is when you are not paying your forbearance program, I was asking her some questions like, what does that do to your interest? Do they freeze the interest, or do they continue to accrue interest? And she was honestly not prepared for that question, because I guess her seniors didn't tell her what the situation is for interest. But she was saying, I would guess that basically the interest would accrue over time. So let's say that of your $2,000 mortgage payment, maybe $1,500 of it is interest and $500 of it is principal, because you're very early on in your term. So she was saying that you basically have to add those $1,500 every single month that you didn't make those payments. So you figure if you do that for 3 months, that's what, $9,000? So $9,000 gets added to your principal. So now you owe $9,000 more on your loan, which could extend your loan, which is pretty nuts. So then what happens if you can't pay it all at once? Because that's the whole point of forbearance, right? You want to get back on your feet and you want to earn enough money to pay them back. Well, there's 2 methods. The first one is you can get it on a payment plan. So payment plan is exactly what it sounds like. Every single month, besides your normal mortgage payments, you're going to pay a little bit more to slowly bring down that debt, and you're going to be current with your mortgage. So everything else stays the same. You still keep the same terms, you still keep the same end date. It's just that every single month you're going to be paying more so that you can quickly pay down what you owe them for the past 6 months. And that's not the best option because it impacts your monthly cash flow. You have to pay more every single month. And also they're gonna show on your credit score that you're on some kind of repayment schedule. And she wasn't sure how that would affect your credit because the forbearance program will not directly affect your credit by saying you're late, but it will show that you are on a forbearance program. So you probably can't get another loan if you're on a forbearance program already. Obviously that sucks. And of course, after you're done with the forbearance, now you're on a repayment plan. So that also shows up on your credit saying, hey, this person is repaying a certain loan. They don't know how that's gonna affect your credit either. So that's the first one, repayment. The second one is called a loan modification. Loan modification is exactly what it sounds like. Instead of having your loan stay the same in terms of rate and term, everything can change. We don't know. You're gonna get reevaluated again. So if you had a great job in the past, and let's say you're bringing in a lot of money, your debt to income ratio is super low, you're getting the best rates, your credit score is amazing, perfect. But if you get a loan mod, all that can change. They can look at you again and then say, oh, well, you had a good job before, you don't have a great job now, so your DTI is really, really high. We don't like that. And we see that, you had some hiccups in the past, your credit score is not as high again. Well, no problem. We're gonna do your loan mod for you, but we're gonna increase your interest rate and potentially, push out your mortgage even further in the future. These are the kind of risks you have to take when you do a loan mod. Like, you don't know how you're gonna be reassessed. Luckily for most people, interest rates have dropped significantly in the past. So if you got your loan a couple years ago and your loan's at, let's say, 5%, then even if you get your loan modified, then maybe they'll say, all right, we can probably keep at the same interest rate or might even drop it because it's kind of like a refinance. They're looking at you all over again and redoing your loan. To be honest, based on a conversation with the rep agent the other day, it just sounded like it wasn't worth the effort. If you can make the payments, just make the payments. Delaying by 6 months to a year sounds great, but if it comes at the cost of either getting your credit affected because you have forbearance on it, or you're on a payment plan, or you have a loan modification, it's just too risky. So again, if you need it, it's there for you. Absolutely, that's the reason why they created it. But if you're just trying to find a way to delay payments so you can keep your cash and maybe invest it somewhere else, I'm gonna agree with you. I don't think it's really worth the time. That's why I decided, I think I'm not gonna go through with this forbearance. Also, I hate filling out paperwork too. It's a pain in the ass. So instead of doing all that work, I think I'm gonna just try my best to continue making the payments. Of course, if things really, really go bad, you can always call them back and then say, hey, look, I called you a couple weeks ago. I already inquired in the past. At the time, it wasn't really for me. Now I like to be on that. They should be pretty understanding. And if you need it, definitely go for it. Well, that was my thoughts on the forbearance program. Are you gonna take it? And is it worth the trouble just to delay your payments? If you guys enjoyed this video, please smash that like button and subscribe to the channel to see more videos just like this one. Thanks again for watching, and I'll see you next time. Take care.